Hey guys, Brown Asset Management here, and today I'm doing a stock review of Walmart, ticker symbol WMT, using my 6 simple steps. Stick around to the end of the video to see if I think Walmart is still a buy in 2021. But first, please leave a like and a comment if you enjoy the video, and subscribe if you enjoy investing in stock analysis videos. So let's get into a quick summary of Walmart. Walmart engages in the retail and wholesale business. The company offers an assortment of merchandise and services at everyday low prices, and it operates through the 3 following business segments: Walmart US, Walmart International, and Sam's Club. The current market cap of Walmart is $406.7 billion, and let's take a look at the share price over the last year. As you can see, in March the share price dropped to around $104 during the pandemic. It's steadily climbed since then and hit its all-time high of $152.86 in December, and has dropped a little bit since then, hitting $140.49. Now let's have a look at the 6 simple steps, and the first step I'm going to be looking at today is P/E ratio less than 20. P/E ratio is the price to earnings ratio, and this is calculated by taking the stock price and dividing it by the earnings per share. And the reason why I've picked 20 is because 20 is the historical average of the S&P. As you can see, the P/E ratio is 20.8, so that is a fail, but very close nonetheless. Now I'm heading over to the financials to look at the next steps, and the second step is the revenue increasing over the last 5 years? The revenue is the income generated from normal business operations. The revenue has gone from $482.31 billion to $523.96 billion, so as a pass there, the revenue has increased. Step 3 is the profit increasing over the last 5 years, and the profit is the revenue generated from business activities when it exceeds the expenses and costs and taxes. The value here is net income after taxes on Interactive Brokers, and the profit has gone from $15.08 billion to $15.2 billion. So that is a pass there, a very small pass, but a pass nonetheless. Step 4 is the shares outstanding decreasing over the last 5 years. And the reason why we want these decreasing or flat is because if you own one share of a company and they have 10 shares outstanding, you would then own 10% of that company. If they create 10 more shares, there are now 20 shares outstanding, and then you would own 5%, so that dilutes the shareholders. So we want this decreasing or flat. The shares have gone from 3.16 billion to 2.83 billion, so that's a pass there. Walmart are buying back their shares with their free cash. Just want to say thank you for watching the video. If you're enjoying it, please leave a like and give your comments on Walmart, and subscribe if you enjoy stock review videos. Let's continue on with the steps. Step 5 are the current assets greater than the current liabilities. The current assets represent all the assets of a company that are expected to be sold or used through standard business operations within 1 year, whereas the current liabilities are the company's short-term financial obligations that are due within that 1 year. The current assets of Walmart are $61.81 billion, and the current liabilities are $77.79 billion. So that is a fail there. They cannot pay out their current liabilities with their assets. Now to look at step 6 is the free cash flow increasing over the last 5 years. To get free cash flow, we take the cash flow from operating activities minus capital expenditures, and the cash flow from operating activities indicates the amount of money the company brings in from its ongoing and regular business activities, and the capital expenditures are funds used by the company to buy and maintain physical assets such as property, technology, or equipment. That then gives you the free cash flow, which represents the cash the company generates after accounting for all cash outflows. The free cash flow has gone from $16.07 billion to $14.54 billion, so that is a fail there. The cash flow has not increased over the last 5 years. So now I'm going to see how much the company is selling times by the free cash flow. So the market cap is $406 billion divided by the most recent free cash flow, which is $14.54 billion, so that gives around 28. So it's selling for around 28 times its free cash flow. If I was to look at the average free cash flow is 17.42, so that means that it's selling at around 23 times free cash flow. We would like this at about 20 for a company that grows at this size, so these are good numbers, not great. Now to quickly have a look at Walmart's dividend. It is paying a 1.5% dividend. The annual dividend is $2.12. The dividend amount is 54 cents, and the ex-dividend date is actually the 18th of March 2021. Interactive Brokers has not updated yet, so if you want to get the dividend, then I would recommend buying your shares before then. The total cost of the dividend is $9 billion, so that can be easily paid with their free cash flow of $14 billion, so the dividend is safe. Let's quickly have a look at some of the analyst ratings. The Refinitiv rating has it as a buy, with 28 buying, 7 holding and 1 selling, with a average target of $162.61. And the tip ranks have it as a moderate buy with 17 buying, 4 holding and 1 selling, with an average price of $163.74. Now looking at Simply Wall Street, they have it at a fair value at $173.45. So just to quickly summarize my 6 simple steps. Step 1, P ratio less than 20. Walmart was 20.8, so that's a fail. Is the revenue increasing over the last 5 years? It is a pass with 482 billion to 523 billion. The profit has increased over the last 5 years from 15.08 billion to 15.2. Shares outstanding is decreasing also with 3.16 billion to 2.83 billion. Pass there. The current assets are not greater than the current liabilities, 62 billion to 78 billion, so a fail again. And finally, the free cash flow has not increased. It's gone from 16 billion to 14.5 billion, so a fail there. So that is 3 out of the 6 passing. Now to quickly look at my model, I have Walmart at a calculated stock price at $198.38, so it is a buy according to my model. I would say that Walmart is a buy if you're happy with them as a company and you do think they keep on growing. The only worries are that the profit is barely increasing and the free cash flow is actually decreased. If they can sort out the free cash flow, I think they'll be a great company going on in the future and a definite buy. I am just worried that is trending the incorrect way. If the shares pull back at all, I would say definitely buy. I think it's a great price then. It's just at the current level they're at, I'm a little bit reserved due to the decreasing free cash flow. If they sort out that in the next financials, I think it's a great buy. Now to just quickly have a look at some of the technicals. As you can see, in April, the 50-day moving average, which is the blue line, did cross the 200-day moving average, which is the grey line, so that would have been a buy signal there. Since then, the price is over the 50-day moving average, which is a very bullish sign, and even has had some resistance whenever it's tried to cross below that. It has bounced back and continued up. Just more recently, it has broke the 50-day moving average. So let's see if it has any resistance below that, but definitely bullish signals from the technicals alone. So that was my analysis of Walmart, ticker symbol WMT. I want to thank you all for watching. Please leave a like if you enjoyed the video, leave a comment on your thoughts on Walmart, and subscribe if you enjoy investing in stock review videos. See you guys next time.